Good morning, everyone, and welcome to Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, central banks in focus this week with a big decision expected from the Federal Reserve on Wednesday. This morning, the Australia Central Bank shocked the world by hiking interest rates by a quarter point. On Thursday, the European Central Bank, the ECB, is going to announce its decision, and this all follows the Bank of Japan's decision last week to keep rates ultra low. The second thing that you need to know, House Speaker Kevin McCarthy has agreed to meet with President Biden to discuss the U.S. debt ceiling. This meeting would mark the biggest step so far in the debt ceiling standoff between Biden and the GOP, and a big change from the White House's position. This comes as Treasury Secretary Janet Yellen warned that the U.S. will run out of funds by June if an agreement is not reached. And third thing that you need to know, no sign of waning demand for Uber. The ride-hailing platform posted a beat in the first quarter, with revenues surging 29% on the year. Its gross bookings also jumped as mobility, delivery, and overall trips, those remain strong. The company did have a $157 million net loss that was softened by gains in its outside investments. Uber CEO Dara Khosrowshahi said that the Q1 performance was a, quote, result of improved earner and consumer engagement. Julie?
Well, Australia's central bank hiked interest rates by a quarter point. That was a surprise to markets as it kicked off a string of central bank meetings this week. We're going to hear from the Federal Reserve's interest rate decision tomorrow, and the European Central Bank is up on Thursday. Joining us now to talk all things Fed and, of course, what it means for the markets is Canaccord Genuity Chief Market Strategist Tony Dwyer. Tony, good to see you. Thanks for being here. It doesn't feel like the needle has really moved on what the Fed is going to do tomorrow, but there's a lot of chatter about sort of the framing that Jay Powell and company are going to give us. So what are you thinking, and how are you thinking it'll affect the markets?
I mean, truly, the most indicators are so neutral that if you gave me what he would say right now, Julie, I'm not sure I could answer you what's going to happen in the market tomorrow. I just think, what we found is so much intraday volatility is just suggesting nobody knows what to do, and it's a real lack of liquidity. So lesser volume can have an outsized impact on the markets. Trying to game this stuff, I think I'm not very good at it. What I'm pretty good at, I think, is the impact of it over the intermediate term. And the Fed is still raising rates in a historic way into a generationally levered system with significant tightness in financial conditions, tightening financial conditions. That's usually not a great thing.
Tony, people still come to you for a game plan during this type of environment, even though. So what is the game plan that you've been employing? You said in your notes to us a light and tight playbook might actually prevail here. What would that entail?
So it means, listen, we're 15 months into this, right? I'm getting sick of being negative. and it comes from, my reputation isn't that way. It's the other side. But the whole point is it's about the money. Right. And the money, you've got to find a reason or a way to have new money to grow again next year or into the future. So our plan has been not to get so negative. I'm pretty negative defensive from an economic standpoint. I do think we're going to have another move back toward the low. But if you're positioned overly negative, it's very hard to try and take a more aggressive approach there. Like I said, we're 15 months into this. So light and tight means have a little extra cash in your portfolio and don't get overly defensive from a sector positioning. Remember, we advise institutional clients here in the U.S. So for those that can't have cash, I just don't want to be overly defensive because so many areas have already taken kind of a beating.
And Tony, I've heard some chatter lately that if you're in cash or if you're in fixed income generally for that matter, that it's kind of as good as it's going to get in terms of yields and in terms of what you're getting in terms of returns on that cash. Do you think that's true?
You've probably seen the peak in rates, Julie. Ultimately, let's talk about the valuation of stocks versus bonds. So if you look at the earnings yield, and for the viewers that aren't familiar with that term, an earnings yield is the reverse of a PE. So I'm using $210 a share for 2023 earnings. So if you take the earnings versus the S&P 500, you're at about a 5% earnings yield. You're at a little over a 5% yield in the 3-month or the 6-month T-bills. So the point is you're not getting paid a lot to take a guess at what's going to happen with the Fed tomorrow. And that, again, is our game plan. I don't want to bet on it, guys. I don't like to bet at all. I certainly don't like to do it with your money. So I would rather just get the 5% that I can get, which is the same as the earnings yield for the S&P 500, until I get a higher conviction. I think the mistake that so many of us in this business make is we come out with this emphatic opinion like we actually know what's going on. And then when it goes against us, because the conviction level wasn't really high and wasn't based on data, we flip-flop. And I really, really have learned my lesson over the last 30 years to not do that. So I'm gonna heed that lesson and just wait for a better directional move, which can only come from a sharp reduction in the Fed funds rate.
And what about earnings? Do earnings do anything for a directional move from your perspective here?
Not really. I mean, look at it this way. Earnings have come in way better than expected. And people would say, wow, look at how great the market's held up. But then I got to define, Brad, which market. The Russell 2000 on a relative basis to the S&P 500 is literally back to the lows of March of 2020. So the idea that this has been this broad advance like we saw in January, which we did, it just isn't correct. So I don't even know that the market knows how to handle earnings. Ultimately, when you put away all the quant programs and algorithms and formulas that folks like me have, it comes down to money. So you've got tightening financial conditions, which is the real story, I think, of the regional banks versus systemic risk. You've got a Fed that is still raising rates and is likely to stay higher for longer, according to what they're telling us anyway, which means you're not going to uninvert the yield curve. I don't know if that's a word, uninvert the yield curve.
We'll take it.
For some time, which means and you're also at full employment. So where are you going to get that extra money for growth? And that's the challenge I have at becoming bullish too early.
So sort of to ask that question a different way, of those different factors, what do you need to see to get you more bullish? Which of those things do you think is most likely to provide some clarity first?
Now, you could get a bounce. Let's say the Fed suggests that they might ease by the end of the year. Could that create a bounce in the market? Could. There's only one thing, Julie, that's going to really get me sustainably bullish, like my reputation has been over the years, and that is when you have a positive slope in the yield curve, which incents lending. Why did so many people? I answer the question, why does the market bottom in a recession when the data is the worst? And the answer is that bad data creates a sharp reduction in the Fed funds rate. It steepens the yield curve, which means short-term rates are well below long-term rates, which incents banks and lending institutions to lend. We're in the opposite situation right now. So it's really that opening, that visibility into forward-looking money indicators improving through a steeper yield curve really is the only thing.
Our thanks to Tony Dwyer, Canaccord Genuity Chief Market Strategist. Tony, great to speak with you here this morning. Thanks so much.
Great to be with you. Thank you.
All right. Everyone, House Speaker Kevin McCarthy has agreed to meet with President Biden to discuss the debt ceiling. According to reports, the invitation comes amid a renewed warning from Treasury Secretary Janet Yellen that the U.S. could default as early as June 1st. Joining us now with what we can expect from that bipartisan meeting is Yahoo Finance's own Jennifer Schonberger. Jennifer?
Good morning, Brad. That's right. House Speaker Kevin McCarthy has reportedly accepted President Biden's invitation to meet next Tuesday to discuss raising the debt limit. The president has also invited other congressional leaders, including Senate leaders Mitch McConnell and Chuck Schumer, as well as House Minority Leader Hakeem Jeffries. This will mark the first time since February that McCarthy and Biden will discuss the matter at length. House Republicans passed a bill last week proposing to raise the nation's $31 trillion borrowing limit in exchange for deep spending cuts aimed at trying to jumpstart negotiations. But Democrats in the White House have said in the past they won't tie spending cuts to raising the debt ceiling. Biden's invitation came just hours after Treasury Secretary Janet Yellen warned in a letter to congressional leaders Monday that the U.S. government could become unable to pay all of its bills as early as June 1st if Congress doesn't raise the debt limit. The timing sets a shorter deadline than forecasters had previously expected, giving lawmakers just 15 legislative days between now and the end of this month to sort this out and avoid default on the U.S. debt. Yellen warned in her letter, quote, "We have learned from past debt limit impasses that waiting until the last minute to suspend or increase the debt limit can cause serious harm to business and consumer confidence, raise short-term borrowing costs for taxpayers, and negatively impact the credit rating of the United States." As for what comes of this meeting, unclear whether both sides will be able to architect a compromise or whether, in classic Washington fashion, we could see a short-term clean raise of the debt ceiling and a punt till this fall for more negotiations as part of a larger spending package. Back to you.
Jen, thanks so much. Appreciate it. Obviously, a lot of moving parts and developments to keep track of there. Thanks. Let's talk Uber now. Uber speeding into 2023 with the strong first quarter. The ride-sharing app saw a strong boost in ridership, trips up 24% from the year prior. Uber CEO attributing the growth to both consumer and driver engagement as the company focuses on recovering from that pandemic-era slump. And Uber's food delivery arm beat estimates as well. Delivery gross revenue rising to top $15 billion. That's up 8% from the prior year. We're going to be diving deeper into earnings in our 10 a.m. hour. You don't want to miss that as the shares rise 8.5%, Brad.
All right. We are going to continue to watch Uber. And additionally here, we got to get to today's morning brief topic where we're checking in on what top leaders have to say on the bank sector at this year's Milken Institute Global Conference. There, Yahoo Finance had the chance to speak with Citi CEO Jane Fraser on the new wrinkle in the financial sector. Here's what she had to say on the recent collapse of First Republic.
There's a palpable sense of relief from everybody this morning because it's sad to see a bank fail. This was the last remaining main uncertainty of the small handful of banks that did not do a good job with asset liability management and also, were the victim of the steepest rate curve increase we've seen in 40 years. But nonetheless, it is a small handful. And as we look at the overall U.S. banking system, this is a strong, this is a safe, this is the envy of the world.
While Americans might not need to be worried about a cascade of bank failures, there are still several repercussions to be cautious of. Let's get to Yahoo Finance's Rick Newman with the details. Rick, what do we know?
Right, so we don't have to worry about bank failures anymore, according to the financial experts here. You heard what Jane Fraser, the Citi CEO, said there. But there's plenty else to worry about. So there's this credit crunch that is underway, and that is a result of these bank failures and what we've seen about vulnerabilities at banks. So there's a presumption that there are some further vulnerabilities, perhaps not to the level that we're going to see any more bank failures, but we're going to have a big credit crunch coming. We're also hearing a lot of worrisome talk about the debt ceiling standoff and the likelihood that markets have not priced in an ugly ending to that. And then another thing I'm kind of picking up behind the scenes is there seems to be a meaningful shift of capital out of the commercial banking system into what you might call the shadow banking system. And there's no problem with that in itself, except keep in mind, shadow banks, whether they're private equity firms, hedge funds, non-traditional lenders, they are not regulated the way traditional banks are. So if there are some problems down the road with some of those types of institutions hitting the skids, you're not going to see regulators come in and do bailouts. You're going to have to see the market absorb whatever happens. So these are the things that people are worried about here, but they're always worried about something here because, these people get paid to try to anticipate risks and, let's be honest, make money off of them.
Well, Rick, I got to say shadow banking, that term makes my antenna go up because it's another one of those that we haven't heard so much of since the financial crisis, right? And so when you're talking to people there about the risk sort of being transferred, how are they what's the concern level, I guess, about that happening?
I think the concern level is that you could see problems in the mid-tier level of the shadow banking system. These would be firms that most people have never heard of. So, at the top, I mean, shadow banking is firms like the Carlyle Group and BlackRock. I mean, well-known firms that are very well capitalized and very well run. And I don't think anybody anticipates problems at those types of companies. There is some concern that when you go further down, there are going to be difficulties at mid-tier shadow banking firms, smaller private equity firms, for example, that might have some financing issues similar to what we've seen at these regional banks, which is that they're getting squeezed between rapidly rising interest rates and assets that they might have that are losing value on the market. There is no FDIC really for the shadow banking system. Of course, the Federal Reserve can intervene, and it certainly has done that in the past. But you're not likely to see that with regard to what we've seen with banks. It's politically unpopular, for one thing, because it looks like it's just a bailout for rich people, and there are other problems with it. So I'm not predicting, a wave of failures at some level of the shadow banking system, but that is just one of the things that there's a fair amount of scuttlebutt about here at the Milken Conference.
Yeah, love hearing the sort of behind the scenes conversations, what people are talking about there, Rick. Thanks a lot. Looking forward to your continuing coverage and our whole team coverage there. Thanks. All right, let's stick with the banks here. Morgan Stanley is reportedly looking at another round of job cuts, and this coming amid a slump in deal making as recession concerns linger. Here now to expand on the state of the banking sector and investor positioning, we've got David Ellison, Hennessy Large Cap Financial Fund Portfolio Manager. And David, as we talk about now the seizure of FRC and what's been happening in the banking system, there seems to be more discussion now about just how the broader economy is doing and banks effectively becoming less profitable as a result of all of this, hence something like the Morgan Stanley cuts. What's your thinking at this stage in the crisis?
Well, I think, I guess I've been saying that I think we need to sort of look forward and say, okay, well, rates have gone up, the yield curve is upside down, so that's hurting profitability. We've had that before. I think the credit cycle will kick in eventually at some point, probably this year, maybe early next year. And we're already seeing it a little bit in some of the smaller banks where they're having trouble with some of their loans. And that will weigh on profitability. I think the new thing that really stay focused on is what's happening with the flow of deposits and how quickly they're moving around the system, and whether it be digitization of the banking system or the shadow banks or all these other words that people use. At the end of the day, people can get to their money via their phone as opposed to having to go into the branch. That's becoming more ubiquitous. And as I say, we've had a lot of mark to market here with rates and prices of bonds going down. We've also had a lot of mark to market on social media. And that's sort of the new thing that I think we have to understand and corral. And I don't think the regulators really know what to do there in terms of trying to keep the flow of money from being so rapid and so quick like we've seen at some of these banks.
In terms of the financial conditions right now that we're seeing, David, does anything about the current financial conditions spell out to you Q3 2023 recession like we had heard from some of the banks over the course of the earnings season thus far?
Well, I don't think, just because we may have a mild or noticeable credit cycle doesn't mean it's a recession. I think, we've had rates go up, so loans have been marked down. That doesn't mean it's a recession. So I think people are trying to say, well, there's going to be a recession, therefore there's going to be all these other things. We've had, 4 pretty significant bank failures in the face of record low unemployment and a reasonably good growth in GDP. And so I think we're kind of we're trying to say, well, there's going to be a recession, therefore all of these things are going to happen. I think all of those things that are going to happen could happen without a recession. And I think you see that this year where, tech is doing really well and the banks are doing really awful. And those two things can exist in the same universe, which probably never would have happened, 20 or 30 years ago.
Yeah, I mean, as you focus on banks in particular, David, I was intrigued in your notes that you are still looking at what you call the so-called broken names, or you say you're not shying away from them. And we're talking about the other regional banks that sort of got swept up in at least the stock action around all of this: Western Alliance, PacWest, Schwab. Why not shy away from them? Why not be more cautious on them?
Well, I think the hope here is that things will calm down and these companies can get refooted, so to speak, and the stocks will reflect that, in their valuations. And I think the struggle here is that that's taking a lot longer and it may not happen at all. So I think it's, but then the opportunity is pretty large on the upside. So, the problem in banking is that for example, in biotech, you can own 10 names. One name turns into a major company and the other 9 go bankrupt, you still outperform. You don't, because that other company goes up, 100-fold. And in the case of banking, I'm not going to buy a bank today that's going to go up 10-fold, meaning the stock price. And, so you've got to take some chances on companies that while the stocks look broken, the companies are working really hard to get back on sides and there's opportunity there. So that hasn't particularly worked. It worked a little bit in the last couple of weeks, but net it really has not worked, primarily because I'm coming back to this notion that we have to get our arms around what this deposit run really is. Is it a traditional deposit run, or is it something that's going to be more ubiquitous in the system where it's going to happen more and more and unexpectedly because people can move their money so rapidly? So as a bank analyst for 40 years, I don't think of deposits as being a problem. Deposits were always the bedrock of the company. Now they're not, and I think we have to reassess what we own and what we take risks on because of that. And I think the Feds are trying to figure it out, the market's trying to figure it out, and so far everybody's generally been wrong, which is, in a sense, manifests itself in these bank failures of late.
David, I want to come back to something that you mentioned a moment ago in the kind of comparison or contrast of banks or the financials versus tech right now. And tech, largely this year, we've seen that up off of rebound from 2022 and even relief on beating some already lowered expectations. So what from your purview is the status of the health for the tech sector? Well,
I think I'm not a super big tech investor, but I think generally what I'm really trying to say there is that, we've been going into a recession for a year now, maybe 2 years now, and yet, there are certain parts of the market that are very strong. This bank thing that we've had here is really a function of advancing technology in the industry, and tech continues to evolve and change the economy. And so we're looking to the banks to say, well, the banks are in trouble, therefore there's going to be a recession. The reality is, I don't think that's the case. The banks are being, in a sense, blockbustered away through technology, and the tech companies continue to take share, and it's reflected in the market in terms of the earnings and the prices of the stock. So I think that's sort of the way I look at it. And I think that's a broader issue, but I'm not, I think tech continues to transform the world, and the banks have finally the technology issues have finally come home to roost with them. And I think the regulators are certainly behind the curve in terms of trying to figure out what they're going to do and how they're going to, and we'll see what happens. But they got a lot of work to do.
Yeah, most definitely. And if you look at what's happening with some of the fintechs, that's probably evident as well. David, good to catch up with you. Great to get your perspective on this. Obviously, as you mentioned, you've got a long history covering the banks. Hennessy Large Cap Financial Fund Portfolio Manager David Ellison. And coming up next, speaking of perhaps behind the curve, we're seeing Chegg shares plummet some 47% this morning as the company now says it's seeing competition from ChatGPT. We'll give you the details coming up and the opening bell. Now on the opening bell, let's get to some early movers that we're watching today. Uber's one of them. The share's up 8.3%, riding a high as trips during the quarter grew by 24% year over year. That's despite the uncertain economic outlook. The company also expecting to expand profitability again in the second quarter. And Brad, I was really struck that, we're seeing the company fire on both cylinders here in terms of the two parts of its business, right? Mobility bookings up 40%. Delivery bookings up 8%, obviously smaller growth in the delivery segment, but both of them growing and both of them beating estimates.
Yeah, if there's one weak spot that investors are bypassing here, clearly it's the freight. Freight was down over 20%. I'm pulling up the exact number here, but freight took a big hit in that most recent quarter here for Uber. But the good thing for Uber, they got me to rely on when it comes to getting those trips and ordering a lot of takeout and delivery here. Revenue growing 29% year over year, as you mentioned there. It comes out to $8.8 billion here. And it was interesting what Dara Khosrowshahi had said, and we mentioned this on the onset of the show. There you're seeing those freight numbers that I mentioned a moment ago. But they significantly accelerated the Q1 trip growth to 24% from 19% last quarter, Dara saying, with mobility trip growth of 32%, citing improved earner and consumer engagement here. Now, on the earner engagement, think about all of the deliverers or the drivers, the deliverers of persons, if you will. At the end of the day, it's still going to come down how they're engaging that community, continuing to get more signups. They also teased, I think, even more scaling of the platform, which if you're juxtaposing a company like an Uber, which has a much more rounded out business, both in scale globally, as well as some of the features that it offers through deliveries that it manages for food and things of that nature versus a Lyft. I think this is where Uber has really continued to tell that story, where Lyft is kind of falling behind in some of the investor sentiment here, at least in how these shares have been approached by investors on the street as well, Jules.
Yeah, just one other thing to mention here. We've been talking all about the demand side. I want to talk a little bit about the profitability side, too, because the company posted a net loss, right, but also had positive EBITDA, earnings before interest, taxes, depreciation, and amortization, $761 million. That's better than estimated. And Khosrowshahi made some comments about headcount, that it was down because of some of the cuts that they have done. He said, we now expect to hold headcount flat to down through the coming quarters. So sort of participating in this bigger move towards rationalization or just more discipline, if you will, on headcount and on expenses. So that feeding through to that EBITDA and also probably helping matters when it comes to how the stock is performing this morning. So something to keep in mind as well. So many companies that we've heard from who have been cutting heads during this earnings season, Brad.
Absolutely. Well, here's the opening bell on Wall Street. Take a look at the NYSE for a live shot there at the exchange. All right, Atlantic Union Bank shares, AUB is the ticker symbol there, ringing the opening bell at the NYSE. And it's time for a check of the market, sponsored by FlexShares. At this, the top of the trading day, the Dow right now down by about 0.1%. We'll round that off to S&P 500. You're seeing that lower by about 0.2% as well. And the Nasdaq Composite starts off the day in the red as well by about 0.1%. We'll continue to keep close tabs on the major averages as well as the sectors here out of the gate here. Just a brief check on those 11 S&P 500 sectors would have us largely down here across the board almost. Utilities and technology really the only two bright spots. Technology leading the way with about 0.1% in gains. But the biggest laggard here out of the gate is energy, followed by materials. Another earnings story that we're tracking here this morning, Marriott out with better than expected quarterly results and a boost to its full year forecast as it benefits from pent up travel demand. Shares right now as we begin trading are up by about 3%, well, 2.4%, we'll round that off too. It was interesting the number of different rooms that this company is accelerating, bringing online. Julie, we've continued to hear this in the story, trying to increase the capacity, and that's something that we got an update on in this most recent quarter as well. The company talking about how they are kind of bringing those rooms online, and that's going to help them service so many of the consumers that have opted for other services, whether that be an Airbnb or whether that be one of the other hotel chains and providers, but all of them are looking to add on more capacity here. As I'm just thumbing through my notes, trying to find that exact figure for you. We'll circle back to it. Let me bring you into the chat here.
Yeah, I'll bring you some other figures here. Revenue per available room, RevPAR as they call it in the industry, up 34%. And so that's a positive number for Marriott. Something else that is interesting about Marriott that I saw pointed out in some of the coverage this morning is the U.S. tends to lead other markets internationally. In other words, the recovery here happening, and then we'll see also recovery happening in other parts of the globe. I was just looking, Marriott gets about 75% of its revenue here in the U.S. Its competitor Hilton gets about 79% of its revenue in the U.S. So Marriott a little more weighted to those international markets, and then therefore, at least in theory, should benefit as we see that catch-up travel happening in those markets as well. And obviously, some Americans are traveling to those markets as well. It's not just people traveling within those markets. So that's something to keep in mind, too, as we look at this whole travel rebound story.
Yeah, and that story amid Marriott continuing to repurchase its own shares, part of a plan that they had rolled out. About $1.1 billion of those shares repurchased, 6.8 million shares during the first quarter. And coming back to that number that I was referencing earlier and the number of rooms that they're looking to bring online, the company added about 11,000 rooms globally during the first quarter, roughly 5,800 rooms in those international markets you were speaking about as well, and 2,700 conversion rooms. The pipeline here that they're trying to get to as well, the pipeline that they have totals more than 3,050 properties, approximately 502,000 rooms. So a lot of construction, a lot of development that they are looking to bring online, about 200,000 of those currently in construction right now.
Yeah, they're really trying to take advantage of that, obviously. Let's move on to another mover that is moving a lot, and that is Chegg. The shares plummeting some 45% right now after delivering lower than expected second quarter forecasts. The education tech company seeing impacts from ChatGPT. And we actually had the chance to speak with Chegg's CEO, Dan Rosenswag, about AI. We talked to him in Davos earlier this year, and it just puts a fine point on how quickly things have changed. Listen to what he said then.
I think we'd all agree after using ChatGPT, even as extraordinary as it is, and even as the evolution that's going to come, it still needs human editors. The user interface, although cool, isn't really valuable to the students who are looking to learn and to evolve and need multi-platform, multimedia way of learning. So we'll use it to continue to enhance what we offer, and that's why our service gets better and better and better, and our NPS scores are through the roof. And so actually, I think it's going to be a real benefit to Chegg.
And so I think this just, again, emphasizes how quickly things have been evolving when it comes to the use of AI. Yahoo Finance's Josh Schaefer is looking at the Chegg story for us. Josh.
Yeah, Julie, so you sort of pointed to how quickly things have changed, right? And that was Rosenswag back in January. And he noted on the call yesterday that basically up until March, they hadn't seen a substantial impact from ChatGPT. But then he said on the call, however, since March, we have seen a significant spike in student interest in ChatGPT. We now believe it's having an impact on new customer growth rate. Basically saying ChatGPT is part of the reason for that slowing business that Chegg was talking about. It was interesting too to note, Brad, that was not brought up by analysts on the call. That was part of the prepared remarks.
Right.
They were prepared to talk about ChatGPT and say, this is a little bit of a growing problem. And then it took over the call. Then they just basically chatted about ChatGPT for a while. And one thing that stuck out to me was our friend Brent Thill over at Jefferies specifically asked them, are you contributing this loss 100% or the decline 100% to ChatGPT? And Rosenswag said yes.
Wow.
He said it was not changed until March. He repeated that line again. And that just really stuck out to me when you think about the effect that ChatGPT is having.
Even when they said that they've essentially tried to cozy up to ChatGPT and include this within Cheggmate as well. So it seems like that's not going as well as planned.
Well, Cheggmate didn't seem to be the answer, at least for Wall Street analysts last night, because they don't have clear answers on how much they're going to invest into Cheggmate, what the revenue proposition is for Cheggmate, and when Cheggmate's coming to market full time. So later this month, they're going to launch part of Cheggmate, sort of a beta version of Cheggmate. But that's also the end of the school year. Chegg is a school platform,
right.
So they operate in the fall. So we're not going to get a clear look at Cheggmate until at least the fall, likely 24. And now basically analysts are saying this all revolves around AI, and Chegg doesn't have their own AI. Like you said, Brad, they're partnering with OpenAI.
Right.
So from an investor perspective, if they don't own their own AI platform, that's less attractive as well.
Josh, just a little bit of like man on the street reporting or anecdotal reporting on this. You guys had the chance to meet my younger son last week when he was there for Take Your Child to Work Day. I have an older one as well who is in middle school, and he told me that kids are already using ChatGPT for their assignments. Now, if you're talking about 13-year-olds that are already using this, that, middle school is not really Chegg's bread and butter, but you're talking about future potential customers who are already going to be AI native when it comes to how they're using it. Now, eventually, maybe the schools will figure out a way to block this in some way, but it just sort of tells you where the future of education could be and some of the challenges that are going to be ahead for the company and for the education system, for that matter.
Well, and Julie, with that too, Brent Thill also noted in his note that that's something that Chegg had grown on, right? Was word of mouth around, say, college campuses. Chegg became very big. I remember when I was in college, everyone was using Chegg, right? It became very popular. In some ways, it was used for students to cheat in the same way people are afraid that ChatGPT could be used for students to cheat because it can sort of give you answers. But basically, his base case was, well, if that's how Chegg spread, and now people are talking about ChatGPT in the same way and it's spreading among students, then you could see basically what was the former growth story for Chegg now playing out for ChatGPT and OpenAI and taking back that market share.
All right, investors today not grading Chegg on a curve here, it seems. Shares down by about 48%. Our own Josh Schaefer covering the story for us. Thanks so much, Josh. Also, everyone, coming up on the other side of this short break, lights, camera, strike. What the Hollywood writers' strike means for the future of media. It's next. For the first time in 15 years, thousands of television and movie writers declared a strike and then headed to the picket lines this morning, bringing many productions to a halt. The move comes after studios and writers failed to reach a new contract before the current deal expired. Yahoo Finance's Ali Canal joins us now with the details and the implications. Ali.
Yes, Brad, 11th hour agreements and nothing worked. A deal was not able to be reached. We have the first strike in 15 years. And this is far-reaching complications because it's not just the writers that are affected by this. It's the production crew. It's the stagehands. It's those Hollywood-dependent businesses like catering, limousine companies that will all be affected by this strike. In addition to that, we have production hubs, not just in LA, but also New York, Atlanta, Chicago, all expected to take a hit as well. The last writer strike wiped off an estimated $2.5 billion from the LA economy. That lasted 100 days from November 2007 to February 2008. And the longer this one goes on, the more implications it's going to have. So at first, the first thing that will be impacted is late night television. So no more new episodes of SNL, no more of your late night talk shows. That's going to be the first to be affected. We have heard from studio executives from Netflix, Warner Brothers, Discovery. They have said in terms of scripted content, they have enough banked to get them through at least the initial portion of this strike. We also heard from some industry executives who told Yahoo Finance other types of implications, especially for the film industry. Here's a bit more of what they had to say.
I think nobody's completely insulated. However, the movie slate for this year is pretty well locked. So, you know, for films coming out this year, the strike really doesn't have an impact. It's a question of how long it goes on for and what happens next year.
It will not impact, of course, the Barbie movie, which is out soon, but we're looking to see how it will impact the rest of the business. Of course, we have multiple projects in the making. Some are relatively advanced than others, and we'll have to continue to watch the space and make sure that we manage it properly.
So films relatively insulated, at least for the 2023 season. But again, we're going to have to track this to see how things continue and how long this goes on.
So, Ali, what are the two sides saying right now, and sort of what's the holdup or holdups in the negotiations?
Yes, I want to read a statement from the Writers Guild of America. That guild saying in part, quote, "The companies, meaning the studios, behavior has created a gig economy inside a union workforce, and their immovable stance in this negotiation has betrayed a commitment to further devaluing the profession of writing. Studios have closed the door on their labor force and opened the door to writing as an entirely freelance profession. No such deal could ever be contemplated by this membership." Now, the AMPTP, which negotiates on behalf of these studios, they said they were open to more communication, more negotiation. They said they presented a package that does increase those wages, that does increase those streaming residuals, but that the Guild was unwilling to negotiate due to the sheer magnitude of the other proposals on the table. The sticking point here, it seems to be around staffing. The WGA appears to want guarantees for the number of writers to be hired on a TV series, as well as guarantees for how long those writers will be on the payroll. Now, part of that is because the streaming boom has created this world where there are less episodes, there are less writers in the room. It's harder for newer writers to really break into this business. So this is important for WGA members. And if we take a look at the sheer amount of writing jobs, that has increased exponentially between 2009 to 2019. According to the Guild, 70% those jobs have increased, and that has taken down the compensation value as well. So a lot of moving parts here. We'll see if these two sides can come to a deal. But again, the longer this goes on, the harder things are going to get. So they want this to be swift and quick. We'll be tracking it all.
Yeah, but the fact that it happened at all maybe indicates that the negotiations are going to last a bit. We'll see, Ali. Thank you so much for keeping us posted. Appreciate it. Well, coming up, our Brian Sozzi got the chance to speak with the legend Michael Milken about concerns in the banking sector and what he thinks investors should be focusing on right now. We've got that interview next. The theme of this year's Milken Conference is Advancing a Thriving World. It's an optimistic take, but perhaps not unexpected for a man known for being a pioneer in the financial services industry. Few names in the world of finance are as evocative as Michael Milken. An investor in everything from private equity to venture capital, in the 1980s he rose to prominence for issuing the original high-yield debt instrument. Call it junk bond if you want. That's what many people do. He used them to finance leveraged takeovers and the so-called corporate raiders who rose to prominence at the time. In 1988, he was charged with securities fraud, serving 2 years of a 10-year sentence, and his absence led to the collapse of the junk bond market and his investment bank, Drexel Burnham. In a 2006 article, The Economist summed it up. Quote, junk bonds helped reshape and modernize corporate America, no matter how unpopular they were. He hit the headlines again in 2021 with his moves in the SPAC space, showing how shrewd timing made them just as valuable to him as the so-called junk bond trades of prior decades. More recently, he's been synonymous with global philanthropy through his Milken Family Foundation, the focus of which has long been education and the ability to influence policy. Yahoo Finance's executive editor Brian Sozzi spoke with him about turmoil in the banking sector and the latest developments in healthcare.
This is my 51st year of putting on these conferences, so this is our 26th at the Global. I think what you're seeing here is the playing out of interest rate risk. A lot of people focus on credit risk, but didn't really focus on interest rate risk. And the artificially low interest rates we had for a long time, you're seeing playing out in Silicon Valley Bank today and First Republic and other institutions where they borrowed short and lended long. You would think you would have heard all these things from the 60s, 70s, 80s, 90s, that we would have learned our lesson. And in the 80s, the highest rated banks in this country were basically in Texas, and none of them survived independently. But this is still a small sector of 4,500 to 5,000 banks, and the banking system itself has built up substantial equity and safeguards. So this isn't really an issue for the overall banking system. But the reserves they've set aside for credit losses, etc., they can absorb. The issue here is the mistake that anyone can make, having short-term liabilities and long-term assets. In the case of First Republic, heavily fixed-rate intermediate-term mortgages. In the case of Silicon Valley, heavily government and agency securities.
What do past banking crises suggest on what may happen in the future, especially as the Fed is still out there raising interest rates?
Well, I would say to you the banking system is substantially stronger today. We have a lot of banks in the United States, but you have a lot of financial institutions that have been built. During COVID, you had companies like PayPal or Visa or MasterCard that helped carry people over. Institutions like the IMF came in and supported 95 different countries in the world. What we're really seeing here is the playing out of those really that mismatched, borrowed short, they're borrowing at little to no cost, and bought portfolios that yield 2 to 3%. So there's 30 trillion in the world, and the largest holder of these assets is the Fed here in the United States.
How should the average investor who's on Yahoo Finance, should they be concerned by what they're seeing in the banking sector?
I don't believe so. You've seen both in First Republic and in Silicon Valley that all deposits were made whole. The average investor only has less than 250,000, which is all insured. And if you looked at, say, Charles Schwab, they have over 300 billion in deposits to start the year, but the average account was $20,000. So this is not the 1980s, it's not the 1970s, it's not the great financial crisis, but it's a lesson again that we need to match those that buy long-term assets with those that have long-term liabilities, like pension funds, insurance companies. And our financial institutions cannot run a mismatched book of short-term liabilities and long-term assets.
Is greater regulation the answer? Does that help that?
I don't think so. I think supervising, and I think we really forgot to look at interest rate risk. So you have a lot of analysis going on in risk. And the great financial crisis, probably the most amount of money was lost in AA or AAA securities, particularly related to real estate. So I don't believe that's it. I think understanding that you have to match your liabilities and assets, and the average bank is leveraged 8 to 1, 10 to 1. So if your assets go down 10% just due to interest rates, you're putting at risk, and you're really not serving what was the purpose of a bank, and that was to match your liabilities and assets. If you had floating rate assets, it wouldn't have made a difference. They would have gone up at that point in time.
And that was Michael Milken, Milken Institute Chairman, alongside Yahoo Finance Executive Editor Brian Sozzi. And stay tuned for Brian's next interview from Milken, where he'll speak to the CEO of Mondelez about why consumers aren't shying away from snacking despite price hikes. We've got that interview for you in the next hour. We'll be right back. Welcome back, everyone. We're almost 30 minutes into today's trading activity and taking a look at the major averages first and foremost here with a brief check of the markets. Dow Jones Industrial Average is down right now by about 0.5%. Nasdaq Composite, tech-heavy average, you're seeing that down by 0.25% here on the day early in trade. And the S&P 500, that too, down by about 0.5%. We'll round that off too. Want to take a look at some of the trending tickers, some of them earnings related, some of them moving in tandem with other names that reported earnings. Yeah, I'm zeroing in on Lyft here. Lyft is down by about 2% this after Uber reported their earnings. Now, Uber, you're seeing those shares continue to hold on to gains here on the day after topping expectations on revenue, and ultimately the shares right now, they're up by about 6.2%. Also want to take a look at the sector activity here right now to see where things are continuing to transpire. As of right now, you're seeing energy bringing up the caboose. That's down by 3% here on the day. We'll continue to watch XLE, but you've got some bright spots. That's in the form of XLV, so healthcare doing well here today. Pfizer, no doubt, perhaps on the mind of some investors. We'll continue to talk about that a little bit later on, but much more to come here on Yahoo Finance as we dive into what's moving, as well as some of the top stories that we're tracking here, as well as JOLTS, job openings, falling below 10 million for the first time in almost 2 years. We'll break down the data next. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're continuing to track markets here this morning. Major averages, they are down across the board right now. Taking a look at the Dow, the S&P 500 and the Nasdaq in the red. The Dow leading the declines on a percentage basis and point basis, down right now by roughly 0.5%. Now on over to Julie with some breaking news on job openings. Julie.
Yeah, the so-called JOLTS report showing the number of job openings falling to about 9.6 million in the month of March. That's from 9.9 million the month before. It's also below where economists had seen the number at about 9.7 million. Forgive me, before I was looking down at the numbers. So indeed, we saw this decrease here. The number of hires and total separations, little changed. Hires 6.1 million during the month, and total separations, people leaving jobs for various reasons, 5.9 million during the month. So that 9.6 million that I mentioned was down by 384,000. It's to compare it with the recent trend we've seen, it's 1.6 million lower than in December. So effectively what we're seeing now is some of the layoffs that we've been talking about start to make their way into the job market. Can we describe the job market as still seeing slack? In other words, is there still room for a lot of job openings and people to be hired? I mean, 9.6 million is still a lot, but it's just that we are seeing a different kind of trend than we had seen.
Yeah, indeed, Julie. And taking a look at some of the other context provided as part of this report, too, the number of total separations over the month, it decreased actually in accommodation and food services, but it increased in construction. Those separations there were up by about 104,000. And then looking across a lot of the layoffs and discharges that took place, that increased in construction as well, 112,000, and accommodation and food services, those layoffs and discharges were up 63,000, while healthcare and social assistance, that was up 42,000 as well. So just to get a sense of where some of the layoffs were occurring largest, at least on a sector basis, those seem to be the areas, at least of that 1.8 million layoffs and discharges numbers, that really accounted for the most among some of the sectors that the BLS is tracking here.
Yeah, of course. And, we know that the job numbers data operates with a lag to much of the other economic data, but it's still obviously something that the Fed factors in. So let's now turn to how we could see this latest piece of jobs data affect how the Fed is thinking. Stephen Rasciuto is with us. He's Mizuho U.S. chief economist. Steve, it's good to see you. So obviously this is just one data point, right? We put it into the overall jobs picture. But how are you thinking about the framing of jobs right now as it relates to what we can expect from the Fed?
It's interesting you ask that question that way because, going back to when the chairman first began talking about the degree of tightening that had already been implemented and the market began discounting the fact that the Fed would pivot this year, he talked a lot about the job openings numbers. And when he was talking about that, he was trying to emphasize the reason why the Fed needed to continue to raise rates more aggressively than the market was anticipating. What you're seeing starting to happen was the scenario that he laid out, that the Federal Reserve's tightening would bring about an environment in which job openings would decline, but employment wouldn't necessarily be hit dramatically, nor would the overall level of the unemployment rate. And they were trying to suggest that they could achieve this kind of soft landing environment in the labor market by their tightening in monetary policy. And clearly the numbers that come out today kind of fit that scenario is there. We still think that the unemployment rate needs to move higher, and we think we will get into the 4.5–5% area before we're all said and done in terms of the jobless rate. But clearly the numbers that we have here showing us that the Fed's initial interpretation that we would have hiring, we would have openings come down and not really impact hirings or that matter quit rates yet, is starting to come to fruition. It adds to the view that this Fed is likely to raise 25 basis points more at this week's FOMC meeting and then probably pause and assess where things go.
When we think about the employment situation, Steve, leisure and hospitality, that had still been trying to claw back or at least get back to pre-pandemic levels for such a long time. And so if there was a sector that led some of the layoffs, the discharges that then started to really show up within that unemployment rate that you were and the target that you put forth a moment ago, what would you be looking across in terms of that sector to lead that?
Well, I think one of the things you have to keep in mind about that particular sector is that COVID changed the nature of that sector. When you check into a hotel these days, you have the option of having turn down service. You have the option of having laundry service. You have the option of having new fresh towels provided versus not having any service whatsoever. And that's reduced the staffing requirements. People have gotten used to waiting longer at restaurants than they would have been before. There's certainly more tables with a lot of the outside dining relative to the staff environment. So, you've had some dynamic shifts in there. And I'm not so sure, even though we've gotten back to these levels of employment, higher levels of employment in those areas, I'm not so sure we're going to be going back to the trends we were prior to COVID because we've changed the nature of way we do some of those businesses as a result of the COVID environment.
I got to ask about a different line of business, Stephen, and the effect that it has had on the economy and the Fed, and that's banking, of course. And we not only now have the bank earnings under our belt, we also have another bank failure and seizure under our belt in First Republic. And as you think about how that's affecting financial conditions and then the Fed's job, how is that going to affect things going forward? Even if the Fed still raises rates quarter point tomorrow, what then is going to happen going forward?
Again, with regard to that particular situation, we laid out a second half recession forecast back around of Thanksgiving. And, when you'd say before Silicon Valley, I was questioning whether or not we would have a second half recessionary environment. Clearly, what's happening in terms of a reduction in bank liquidity, which will probably come out from the senior loan officer survey this afternoon, you're going to see that bank liquidity is going to contribute to a recessionary environment. But it's not a systemic credit crunch. It is a credit crunch where we're basically reducing the amount of liquidity in the system. We're not drying that liquidity up. And the net result is the impact will probably increase a second half recession, which is why I was talking about the fact in terms of the labor market that we're going to get back to that 4.5% to 5% level on the unemployment rate from the 3.5% level we are right now. That's a nice particular deterioration, but it still leaves us in a very, very healthy labor market environment relative to many other business cycles.
Steve, this might be too much of a futures type of question, but I suppose because we're seeing the news around companies like even IBM saying that they're going to pause hiring in some of the plans that they have, at least, because AI can do roles that they're thinking about in the future. This could impact more than 7,000 jobs is what they're projecting at this point. And so that considered, how far off are we until we see some type of artificial intelligence input that trickles through to either job openings or broader employment situation data?
Yeah, that's unfortunately an imponderable. I heard the IBM announcement myself this morning and scratched my head. When I look at those kind of situations, remember, IBM is a company that has been a mainstay in the computer industry since I was a kid, and it continues to be a mainstay. But it is not the leading edge of the growth engine in terms of the tech industry, and that's where the jobs get created. It's the leading edge of the economy that creates the new jobs. Companies that have been around for a long period of time, they go through these kind of environments. They can't keep on innovating. They can't keep on pushing the top line. So the way they drive the earnings number is by reducing the cost structure. Again, nothing against IBM. It's just the nature of the beast. And I think in this particular environment, that's kind of what we're seeing. They're looking for ways to juice earnings in an environment where the world is kind of moving away from them.
And Steve, if we're looking at, these kinds of pressures coming to the fore, as well as what you described as that shallow recession, for lack of a better word, what is that going to feel like in the second half of the year for regular Americans?
Yeah, I mean, to be honest with you, the type of deterioration we're talking about in terms of the labor market is really not going to be a frightening environment for the average American. Yes, some people are going to lose their jobs. There's no doubt about that. Going from 3.5% to 5% on the jobless rate is going to have an impact. People will lose their jobs. But we're not talking about an environment where consumer liabilities become a systemic issue for the banking industry, where there is wholesale default, where there is a concern about underlying creditworthiness of the consumer sector. We're right now at a position where a couple of the financial institutions that lead the edge in terms of consumer lending are saying, we're just back to 2019 levels on consumer defaults. And we got very upset at them for having said that. 2019 was an incredibly healthy year for the economy and the consumer. And therefore, we're starting from a very, very solid base in terms of consumer financials. Yes, there'll be some deterioration from here, and I feel sorry for the people who are going to experience that deterioration, but that deterioration is going to come nonetheless.
Yeah, definitely something to continue to watch. Stephen, thanks for your perspective this morning. Stephen Rizzuto is Mizuho chief economist for the U.S. Thanks.
Cheers.
All right, we got to get you a trending ticker now, and it is Pfizer. The company seeing declining sales as the waning COVID-19 pandemic tamps down market demand for its medicines like the vaccine and like the treatment Paxlovid. The shares aren't much changed, though, down just 0.1% as it reports a revenue drop of 29% for the first 3 months of the year compared to the same period a year ago. Pfizer, though, also seeing revenue in the first quarter growing, even excluding those COVID-related products, largely driven driven by some new acquisitions. And of course, its acquisition of Seagen is pending as well. Our Anjali Kanlani, who covers healthcare for us, is listening to the Pfizer call right now, and she's going to have an update with some more context in the next hour. But coming up next, banking on a buyout. How will JPMorgan benefit from its acquisition of First Republic, and how will that transform the banking landscape? We'll speak with two experts next.
Let's do a quick check of the markets here, sponsored by Flex Shares. Taking a look at the major averages here in the U.S. The Dow down by 0.9% right now, accelerating some of the losses that we saw earlier in trade. We're seeing it on a point basis lower by 316 points right now. The S&P 500, that's down by about 0.9% as well, about 38 points in the red. And the Nasdaq Composite, that too, down by 0.7% right now, 86 points in the red for the tech-heavy average. Julie?
Well, JPMorgan's buy-up of First Republic Bank after that company's failure marked the second largest bank collapse in U.S. history was aimed not just at getting a good deal, but at capturing more of the wealthier client that First Republic thrived on. Joining us now for a look at the hidden benefits from JPMorgan's buy and also the effect overall on the banking system is Dylan Ratigan. He's host of Truth or Skepticism on Tasty Trade, and of course, a longtime financial news anchor as well. And Rachel Louise Ensign, reporter at the Wall Street Journal. And Rachel, I want to start with you because you wrote about this very issue for the Journal. And it's funny because the reputation of JPMorgan might have you thinking that, well, it's already good and dominant in everything, but this suggests that it wasn't and that this helps it add to that. So talk to us about what this deal does for the bank.
So JPMorgan is very, very good at most things, and they do have a lot of very wealthy customers, but the business they're most dominant in is the very, very, very rich people, not just the somewhat rich people. And they compete with Bank of America, which has Merrill, thousands of financial advisors, and also Morgan Stanley, which has a similar number of advisors. And they have never really been able to compete on the same level as those rivals. And what they are hoping is that this acquisition of First Republic will turbocharge their ability to serve those merely rich people.
So, Dan, at what point do we start to see this trickle through to the financials of JPMorgan? What does success look like for them with getting parts of First Republic assets?
I think success looks like keeping those customers. First Republic had a very specific business model, and people stayed there because they loved their First Republic banker and the personalized service that they got. And it remains to be seen if JPMorgan, which has a different model and will be getting rid of the First Republic name, clearly going to be changing a lot of the way that they do business, will keep those customers.
And Dylan, I know you think a lot about sort of the bigger picture here and what this is going to mean for the banks, that JPMorgan is getting more dominant potentially in another area. How should we be reading this?
Yeah, I mean, I think that, you have the rules as they're written on paper and as we pretend that they are with the legislation and the whatnot, and then you have actual reality. And so the rules as they're written on paper are no bank should have more than 10% of the assets, that insurance on deposits is capped at $250,000, all these rules. What's been made very clear going back, now to 2008, and we saw it in the pandemic, we're seeing it this year with the bank failures, is the actual rule is whatever unlimited amount of money that the government wants to provide at the time. And in JPMorgan's case, and then in the big bank's case, JPMorgan can't lose on the First Republic deal. It's similar to when JPMorgan purchased Bear Stearns. All of the risk resides with the taxpayer, basically, or with the really with the FDIC, which I suppose is one step away from the taxpayer because of the fees that are paid. And JPMorgan just ends up with a creative deal immediately, right? I mean, if I give you First Republic Bank and you don't have to buy it, and I absorb the risk for it, it's inherently good for you. The question is, how long are we going to pretend that we function as if we have a nationalized banking system, I guess is my point. And yet we pretend that it's a private sector risk management, but it's not. Because the consequences for bad management are entirely borne by the small banks. The large banks have no liability because they're a special class, and then they've been empowered as a special class to even get waivers on the rules to get bigger. The real question is, why are they withdrawing credit when there's an unlimited supply of funds being provided to them implicitly by the government? And so what I really am more curious about is the premise of, credit contraction because of the banking crisis, when the banking crisis is really a fabrication, because at the end of the day, the same way the Swiss are going to fund UBS to buy Credit Suisse, the Federal Reserve and the government is going to ultimately make sure that JPMorgan and Bank of America and the big banks have custody of whatever financial assets.
Certainly. So Rachel, all this, in regard, what does this mean for some of the smaller banks, the regional banks that were looking to get bigger as part of the bidding into these talks as well, after the FDIC had receivership of the First Republic assets? You had banks like PNC who were reportedly in talks looking to get bigger on this too.
Right. Well, we've reported that there were 3 large regional banks that did bid and were in pretty advanced talks with the FDIC for the First Republic deposits and assets, including PNC. But at the end of the day, they say that they have to go with the offer that presents the least risk or the least cost to the deposit insurance fund. And JPMorgan is just so large that they were able to use their balance sheet to make an offer that none of these smaller banks could compete with.
And Rachel, nothing sums up the whole situation better than the primacy of size, which then begets guaranteed authority over the market.
I mean, I guess, Dylan, then my question is, like, what are the ultimate implications of this? If you're an investor, I mean, you got to think. You
want to own the big banks. I mean, you set aside your morality. I mean, at the end of the day, you want to own the large financial institutions that are sponsored by the U.S. government. And then if you want to have a discussion about what your opinion of that fact, do that on Sunday, but don't do that when the market's open.
Dylan Radigan, host of Truth or Skepticism on Tasty Trade, and Rachel Louis-Ensign, who is the reporter at the Wall Street Journal. Thank you both for joining us here. Really insightful conversation this morning.
Thank you, guys.
Coming up, rise of the robots, why artificial intelligence is cause for concern at some companies. We'll discuss that next. From the onset of automation, employees across several areas of the economy have feared that there would be a time when machines would take their jobs. A new report from Bloomberg says that that's what's happening at IBM. CEO Arvind Krishna is reportedly pausing hiring for roles that could be replaced by AI. And this comes after Dropbox warned of layoffs, noting the need to incorporate AI. Yahoo Finance's Diane King Hall has the details here for us.
Yeah, that's right. Well, the robots are coming, and that means thousands of jobs are heading to the chopping block. According to Bloomberg, IBM CEO Arvind Krishna says hiring in back office roles will be suspended or slowed amid advances in artificial intelligence. Now, Krishna says he could easily see 30% of non-customer facing roles being replaced by AI and automation over the next several years. Currently, headcount in those back office jobs stands at about 26,000 workers. So a reduction in those roles would translate to about 7,800 jobs gone. What jobs or tasks stand to be affected? Well, IBM's CEO says it would be roles that involve mundane tasks like providing employment verification letters or moving employees between departments. So that means roles in HR, which is surprising, but it's not just IBM. Dropbox is actively taking the hatchet to its workforce. Dropbox says it is laying off about 500 workers. That translates to around 16% of its workforce. CEO Drew Houston blamed the economy, but also laid out a vision to boost the company's AI division. This is what he said in a letter to employees. This is an excerpt. Quote, "In an ideal world, we'd simply shift people from one team to another. However, our next stage of growth requires a different mix of skill sets, particularly in AI and early stage development," end quote. So as you can see, Brad, the pivot to artificial intelligence is accelerating as we speak.
Yeah.
You know?
Yeah, I mean, it is accelerating, Diane. And so what does that mean for the future of work? I mean, it seems like the news today is telling us something.
I know, right? It is, you know, it's definitely the age of artificial intelligence. More companies are taking that on. It's the, you know, I want to make a joke and say the beep boop bop world, or do the robot. I mean, that's making a little light of it, but there was a recent Goldman Sachs report that talked about the advances in AI and, you know, the expectations for how many jobs would be effective. It found that about 2/3 of current jobs are exposed to some level or anticipated level of AI automation. So that means not necessarily all those jobs would go away, but some aspects of those jobs, because it's interesting that we're hearing about roles in HR. That's unexpected to me. I hadn't really heard about that sector of the workforce being impacted by AI. And so, you know, you hear about definitely things in information technology, IT, et cetera, and different operational roles, but human resources is an unexpected area of the economy, Julie.
Yeah, definitely. Well, we'll look for more headlines on all of this. I'm sure there will be many. Thanks so much, Diane. Appreciate it. Well, our own Ali Garfinkel is going to continue our conversation about the state of artificial intelligence with former Google CEO Eric Schmidt from the Milken Conference. That's tomorrow. You don't want to miss that. It's going to be a really interesting combo. But coming up next, Uber is cruising uphill as it continues on its path toward profitability. We're going to speak with Wedbush's Dan Ives on the company's quarter next.
After the call on Starbucks, they got a new CEO that's in there at the helm. We'll hear the voice of Lakshmana Truthan. Additionally, we're going to be watching for any weakness that they're talking about in China. Also, are they still passing prices on to consumers? And if so, where? Keep a close eye on those tickets and what they have to say about it. And lastly, is digital performing well? We already heard this a la Chipotle early on in the earnings season here. We'll see if that's holding true on the digital transformation side for Starbucks and where the app purchases have held up for those rewards members out there.
early last year, before everyone else was raising alarms about the reality of today's capital markets and discipline needed, we raised the alarms internally and we took action early so that we didn't have to be reactive like a lot of other tech companies have been. So like, we're innovating, we're building, while a bunch of people are restructuring.
That was Uber CEO Dara Khosrowshahi highlighting Uber's ambition to innovate. The company reported a revenue beat for the quarter, with its mobility segment building onto 2022 strength as riders begin to take more trips. Joining now to weigh in on Uber's first quarter results, Wedbush equity analyst Dan Ives. Dan, friend of the program, joining me not too far away from another studio, home studio in New Jersey. Good to see you, Dan.
Great to see you.
You talked about in your note that this is an inflection point for Uber. What is sort of causing that inflection point? What is the company doing to now unlock the next phase of growth?
Yeah, I mean, look, Julie, if you go back a year and a half ago, their back was against the wall. And ultimately, what you've seen is they've cut costs, they've gotten a profitability. You know, you have take rates that are up, and you're really starting to see a booking story that I think is not just expanding, I think gaining share from little brother Lyft in terms of domestically. So right now, I mean, this is, I'll call it a trophy case quarter for Dara and the team.
Hey, Dan, when you think about what has to happen now for Uber to really kind of lock in profitability over a long term, what would that look like to you? What kind of pulls and levers do they need to enact?
I think you're starting to see more and more, the take rates are increasing, that they're getting more and more share at peak rides. You're starting to see travel continue to expand. And then at the same time, they've been laser focused on where they're spending money. And I think ultimately that all means you're going to have a free cash flow story that expands, profitability that expands, and bookings that actually goes up in 2023. It's almost like the dream of a few years ago now finally has become a reality for a stock that, in my opinion, is still way underowned.
So what happens on the profitability side, right? When do we get to net profitability? And then do you see, as a result of that, you talked about it being underowned, is that kind of the thing that gets more people to pile in?
Well, I think many investors that I talked to, they've just been skeptical about the story, sneak bitten in terms of the ride sharing space the last few years, always waiting for another shoe to drop. And I feel like finally, look, this is a different Uber, it's a different Dara. And it's a company right now, strategically speaking, that I think you start to look at sustainable profitability into the rest of the year, into 2024. The free cash flow story really starts to come through. Uber One, and even when you look at freight and some of the other initiatives, I think that should add to the sum of the parts. And now this is really, I think an Uber that's on the offensive, not defensive.
Dan, you think about some of the tech companies that you cover, and I mean, over the course of this earnings season, we've seen reactions like this, where ultimately the stocks become extremely volatile, perhaps just rebounding or continuing to have some sense of relief. You know, if there was a way that you'd sum up what we've seen from tech companies over this earnings period, what would it be?
Look, I think it's the same ones that are, skeptical about, ultimately tech being able to navigate the storm. And I think ultimately it's really, as this all plays out, it's important because it's better than feared. I think many have been on the sidelines watching big tech, yelling fire in a crowded theater, still using their 2022 CPI, PPI playbook. And ultimately, that's why tech continues to outperform. And in my opinion, I think that's really the narrative here. You have a tech earnings season that you came in with agita and white knuckles, and at least for big tech, you actually now are drinking a cappuccino watching a lot of these names.
It does feel that way a little bit. I want to ask you about Tesla, though, because there's one where maybe you needed something stronger than a cappuccino. Have you been watching the recent stock action, Dan? The company did just come out and say it was raising some of its prices in China, but also it sounds like in the U.S., not raising by much, right? And so is this just like a bonus throwing to investors, or what do we make of it?
Yeah, look, it's been obviously under a lot of pressure with the 6 price cuts. It's that push-pull. between margins and units. And obviously the stock had a nice rebound that we've seen earlier this year. But going forward, it's about showing that the sustainable growth story in China is there, that the price war that's playing out, they're going to be able to navigate, ultimately to a company that hits 1.8, 1.9 million units, but you're able to have that gross margin ex credit in that sort of upper teen 20% range and going forward. That's going to be the balancing act here for Tesla. Look, I think the stock's oversold, but no doubt it's a prove me story into the second half of the year. And Musk and the team have been there before, but I think you're just going through a digestion period here. But I would rather them put an iron fence around their install base in what is this EV arms race playing out, especially in the 313 era with GM and Ford going all in.
Hey, Dan, while we have you, of course, we do know that you cover Apple. We've discussed Apple at length previously. We're waiting for those earnings to drop this week. And just looking through some of the expectations, especially amid a PC market that is already hit hard, some of the other companies in tech, mega cap tech companies who have seen that demand wane. Apple, of course, majority of their business is the iPhone, but where might this still show up and where else in the business would you be kind of safeguarding against some cracks?
Yeah, look, in terms of Macs, and of course, when you look at iPads, and that was a pull forward post-COVID, those continue to be extremely soft. But this is an iPhone story, and demand continues to uptick in China. And remember, a lot of investors, they despise the stock at 120, thinking it's going to 100. They absolutely hate it at 168. And I think it's just a name, in my opinion, that it's going to be better than feared. I think units are stable. And I think as the baton gets handed to iPhone 15, the anniversary edition to September, this is stock that's going to remain strong. And services, you start seeing more and more of an uptick out of the App Store. I mean, that's key to some of the parts thesis here in Apple. I think gold standard Cupertino continues to play out.
Dan Ives, Wedbush Managing Director and Senior Equity Analyst. Dan, great to see you.
Thanks for having me.
Thanks. Coming up, is snacking recession-proof? We'll head back to the Milken Conference where our own Brian Sazi got a chance to sit down with the CEO of Mondelez, talking all things snacks. That's next. Recession is the unfortunate word of the moment, but we've been hearing another one that goes against the narrative: snacks. A research note from Bank of America last week laid out the growth story. Snack brands are poised to take more share from the traditional food items and can be seen as a good investment opportunity. Don't take it from B of A alone, though. Testimony from PepsiCo to Hershey and Campbell's Soup all attest that American consumers still need a treat, even if they are pinching pennies elsewhere. Where sweet treats are concerned, Chicago-based Mondelez is a power player. Its portfolio of brands includes the likes of Oreo, Cadbury, and Belvita, each worth billions in their own right. And the company's stellar first quarter results were helped by another buzz phrase of recent months: pricing power. Mondelez is just one of a swath of consumer goods groups, utilizing strong operating leverage to boost margins even when times are tough. So, was its best quarter ever a U.S. story or one that translates across Europe and emerging markets? Yahoo Finance's executive editor Brian Sozzi caught up with CEO Dirk van de Put to get some answers.
It started during the pandemic, where the consumer sitting at home got used to have regularly a snack. They needed it, or to share with the kids, or to calm themselves down a little bit in a time of distress. And the habit got installed. Consumers are still spending a lot of time at home. They got used to the brands, they got used to the product. So now when the inflation comes and prices start to increase, it's clear that they are attached to it and that they don't feel like they want to give that up. So that's the fundamentals of what's going on. You also have two new generations, millennials and Generation Z, taking more and more of a percentage of the consumption, and they eat in a completely different way. They're not 3 meals a day type of thinkers. So those two combined, that's really what's causing the success of snacks.
The amount of data you must have on consumers must be mind-blowing. So what you're saying is that maybe this next generation of people in this country not eating dinner, just snacking more throughout the day?
Yes. The average consumer now already snacks 3 times a day. And the percentage of people that's doing that is about 78%. So yeah, we clearly see that habit going up.
Take us inside how you reinvent some of these snack foods. I've seen it in Mondelez. I've seen it in some of your competitors. I've joked with my team that we are now in the golden age of packaged food, where a lot of brands that we've known for many years look completely different.
Yeah, everybody does it in a different way. But the way we do it is we try to find a purpose for the brand that really is linked into the product of the brand, that has to see with the history of the brand, and that really resonates with consumers around the world, because consumers have become very knowledgeable about brands, especially those younger generations. So they want to see something more than it tastes good or it has a great packaging. And if you can link it to a great purpose, that is really what causes the reinvention.
Do you see anything on the horizon that would suggest that the snacking boom, and I'll call it a boom, could end?
No, I don't think it's a boom. If you start to look at consumers since the 60s, snacking has been on the rise the whole time. I think it's only in the last 10 years there's been a lot of discussion about snacking because it's becoming so big. But as consumers live a more mobile life or spend more time at home, both benefit from snacking in a strange way. I think the consumption will continue to increase. The other thing, what's interesting about snacking is that it's an elastic consumption. You can have 5, 6 a day if you would like to. There's no limit to it, versus typical meals, they're more limited in the quantity that you will consume.
What's the outlook for prices on snacks this year?
The what for prices?
Do you have more pricing power, you think, in the products that you sell?
Yeah, unfortunately, the inflation, the input cost inflation that we're seeing this year is as big as it was last year. So we had to price as much this year as last year, which on average is about 12-13%. So the consumer is confronted with prices that have gone up over a 2-year period of 25%. During the last so many years, we've been constantly increasing the investment in our brands, connecting better with consumers. The pandemic arrived with the changes I was explaining. So what's clear is that even when they clearly see the price go up, consumers are prepared to stick with their habit. Going forward, I think what we're seeing at the moment, we're only May, but our forecast is that commodity prices will start to come down. Not that much. I mean, it's really nothing to speak of right now, but it's not going up. Last year in May, we already knew that this year was going to be a big increase of commodities again. We don't see that for 2024. So I think it will start to temper off, and those big price increases should stop second half of this year and beginning of next year.
When you talk to investors, do they appreciate what you have done to turn this company around? It is a different company over the past 3 or 4 years, in part because the products are better, but because of the acquisitions you made. Take us inside your acquisition strategy, and how is this transforming the company? Cliff Bar was one of your most recent ones, right?
Yes. First of all, we changed the mindset of the company from let's try to save money and get high margins to let's grow the business. And that liberates everybody in the company. They love that idea. So that's really the...
What leader doesn't like more money?
Yeah. Exactly. And so as we sort of mapped out where could we go to grow, where is the growth of the future in snacking going to happen, we sort of plotted out who are the companies that are doing really well. And that's really guiding our acquisition strategy. And we've been lucky enough to convince some of those companies to sell to us. And then the other side of that, of course, is once you have bought the company, you need to have a real playbook on how you're going to integrate, how you're going to keep the talent, how you're going to get the cost to be reduced, how do you grow faster. And so far, we've been able to execute against that playbook. But we're very disciplined in what are the financial criteria, what needs to be in place, what growth do we expect, and so far that has really worked out for us.
Do you want to just stay in snacks, or you're now eyeing a push into beverages? What other categories do you find attractive?
Not really, no. I like where we are. We want to be the company in chocolate and the company in biscuits and baked snacks. That universe is big, it's growing, there's plenty of opportunities for us around the world, that's what we know. So it seems to make sense to stay there, and so far the growth is really coming for us.
Lastly, if I did my math right, Chips Ahoy is now 60 years old.
Yes.
How important is that to have a brand like that in your portfolio, and then how do you go upon keeping it relevant for the next 60 years?
Yeah, that's an interesting question, because Chips Ahoy is doing better than ever. We just gave it a big push in China, and it's really booming there. I think the idea of a chocolate chip cookie and a brand dedicated to that, albeit with a bit of a clunky name, I would say, still resonates with consumers. And then we've been able to work a lot on the product itself, worked on the image that the brand has, link it to the right events, the right seasons, and so on. And that's really about keeping the brand alive in the mind of the consumer.
Is that a $1 billion brand?
Yes, it is. It's our 6th biggest brand, yes.
Wow. And then Oreo is still the category leader. How much in business will that do?
Oreo is well over $4 billion now, growing 15% a year.
And how do you keep that brand relevant? Where else do you think that brand has a right to play?
Well, Oreo is about playfulness, and it's about relationship between kids and their parents. And it's a brand that really can connect to special events, or you can make a Batman Oreo, you can make a Lady Gaga Oreo, and so on. So it really is a playful brand that you can link. Oreo, as long as there are categories where the flavor of Oreo and the cookie crumble of Oreo plays a role, like in ice cream, that's the categories we can go in. So we've got yogurt with Oreo, we got ice cream with Oreo, we got pastries with Oreo. That's sort of the universe where Oreo can play.
And that was Mondelez CEO Dirk Van de Poot, alongside Yahoo Finance's executive and editor, Brian Sozzi. Stay tuned for Brian Sozzi's next interview from Milken. He's going to be speaking with Aris Wealth Management's Raj Danda on the state of the banking sector and the future of wealth management. You won't want to miss it. We'll be right back. Let's do a quick check of the market sponsored by Flex Shares. Major averages here in the U.S. hitting some of their session lows here as we're tracking the Dow right now down by more than 1.5%, 518 points in the red. The S&P 500, you're seeing that down by about 1.5% as well, nearly 1.6%. And then additionally, the tech-heavy Nasdaq, you're also seeing that in the red. That's lower by 169 points, about 1.4% in negative territory. All 11 S&P 500 sectors are in negative territory as well, Julie, led by energy and financials.
Yes, indeed. And we should say we don't know what has caused this latest leg down in the markets. We've sort of been looking around here. It just looks like we are seeing a deterioration in sentiment. But you see XLE down more than 4%, and that's on a 4% slump in oil prices. XLF close behind, or not that close behind, actually. There's a pretty big gap there, but it's still down 2.7%, and materials down 2.2%. But what I really want to dig into here is the financials in particular, because we are seeing a big sell-off in the regional banks right now. This is after, of course, the seizure of First Republic and its sale to JPMorgan, that occurring over the weekend and into Monday. And so, you know, we've been talking to folks who are saying, okay, the worst of this is over. The acute part of the crisis is over. But then you get a PacWest that's down another 36% today. You get a Western Alliance down another 23%. So clearly here, the market is saying that this is not entirely done, and it's something that we're going to continue to watch as well. Some of the other things that we're watching, I want to talk about private equity firm TPG. That is moving to the downside, and the decline coming with more negative news for the media industry. Vice, the name making headlines this morning. Once known as a disruptor in the space, the company is now reportedly headed for bankruptcy, and the New York Times is reporting that the filing could come in weeks. Back in 2017, TPG invested in Vice, which at the time was worth about $5.6 billion. Today, worth a tiny fraction of that. Rochelle Akufo is going to dive deeper into that story and the state of the industry coming up.
And plus, we're just days away from touching down in Omaha for the Berkshire shareholder meeting. We've got you covered all week long with expectations for what we might hear from the legend himself, Warren Buffett. In the next hour, we're taking a look at his investments in Japan. Is the next bull market possibly away from home? Rochelle's got the details there too, Julie.
And finally, the earnings parade continuing. Starbucks and Ford are on tap after the bell. The 3 to 5 show is going to break down all the action. And you, Brad, as always, are going to join for After the Call, after the Starbucks call is done, talking about what we hear from the company.
Right, lots to listen to from the brand of the Green Siren. Let's do a final check of the markets here as we're taking a look at the major averages here in the red, as we mentioned, near some of those session lows. We're going to continue to track this, as well as Rochelle Akufo keeping you updated on this during the next hour of trading. Stay with us.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching so far this morning. Bracing for impact, the Fed set to hike as Australia's central bank reminds peers inflation is still alive and well with a surprise move. We look at corporate results and ask, is a sharp slowdown already baked in? And the ride-hailing economy. Uber reports another quarter of strong growth as customers keep drivers busy. Is this a leading indicator of a recession-resilient U.S. consumer? We'll discuss. And Vice Media reportedly edging towards bankruptcy, a staggering fall for what was once considered one of the highest valued U.S. private companies. We talk changing media coming up this hour. First, let's check in on the major indices. We see some selling action continuing to pick up here. The Dow now off more than 530 points there. We're seeing energy weighing on markets, Chevron putting pressure on the Dow. In the S&P 500 there, all of the sectors in the red, they're down about 1.6% today. We're seeing energy and financials as regional banks are struggling as well. And then taking a look at the tech-heavy Nasdaq, down by about 1.5%. Big tech, you have Google, Alphabet, and Nvidia also weighing as we brace for what we hear from the Fed. With that in mind, let's also check in on the Treasury market and see some of the action there. A bit of a flight to safety we're seeing here with that pullback. We see the 5-year now down almost 5% there, 4.84%. The 10-year there off about 3.7%, and the longer-term 30-year yields down 2.3%. Right, turning now to our top story, assessing the Fed's next move as recession fears grow. The ongoing banking crisis and recent economic data coming out this week could influence the Fed's decision. That's even as economists bank on the Fed holding interest rates higher for longer. Let's look at the odds of a recession as things stand right now. Joining us with more, Yahoo Finance's Inez Ferre. Hey, Inez.
Hey, Rochelle, that's right. And we hear it all the time. Are we headed towards a recession, especially those wondering how they should position their portfolio? And while the consensus seems to be that we are heading towards a slowdown, whether technically it is a recession or how severe of a recession, that's where you get some differing opinions. Now, one of the traditional definitions of a recession looks for at least 2 consecutive quarters of negative GDP growth. And depending on the chart you consult, when it comes to the data, well, the results may vary widely, really. You're looking at factory orders. Those have seen a steady decline since the pandemic highs we saw back in 2021. Then while we look at wage growth, that's still elevated. Indicators of sentiment, those are contradictory. And with low unemployment also indicating a tight labor market, though it has been slowing. And Wall Street's fear gauge, the VIX, that's at one of the lowest points in the year. But then what about the corporate side? What are companies saying? We're in the midst of earnings season right now with really a mixed picture. You've got UPS, a logistics specialist that has spoken about lower volume on declining retail sales. Intel still on the decline, showing weakness in chip demand. But then you've got some bright spots. You had Uber reporting, citing strong demand for rides and food delivery. And big banks, even despite those headlines that we've been hearing of layoffs at Morgan Stanley and other places, they're still saying that they are prepared to weather a possible recession. Now, here's what Citigroup CEO Jane Fraser said during an interview with Yahoo Finance at the Milken Conference. Take a listen.
We do think we are probably heading into a recession at the back end of this year. There is likely to be credit tightening. There's some stresses ahead, commercial real estate and the like, but this should be manageable.
So really, the severity of the recession, that is where you do get some differing opinions. Now, even Federal Reserve economists, they predict a mild recession is likely sometime later this year. Rochelle?
Certainly a lot of different signals to keep track of there as people try and gauge the depth of this recession. Great stuff there. Thank you so much, Inez Ferre. Well, inflation and growth continuing to ebb, but recent data showing no evidence of a dramatic downshift in either. Now, that high inflation set to keep the Fed on track with its higher for longer approach to interest rates. Joining us now with how this is set to affect the wider economy is Gargi Chowdhury, BlackRock America's iShares investment strategy head. Thank you for joining me this morning. So, as we were mentioning there, a lot of different indicators that investors are watching. But when we look at investor behavior, how they've been pouring into big tech this year, despite what the Fed has been signaling, how should investors then be positioning themselves right now?
Sure thing. Good morning, Rochelle. It's great to be on the show and good to meet you. So exactly to your point, there is a lot of cross currents in the market right now. Obviously, on one hand, you have what we think is going to be a pause from the central bank after the next meeting tomorrow. On the other hand, you have some resiliency in the earnings forecast as well. Some companies are guiding to an okay year ahead. So a lot of cross currents in the markets, and I'll point to three things. Number one, we think that investors should be continuing to focus on the quality of the names that they own. So whether that's quality in the bond markets or quality in the equity markets, that's going to be paramount as we go into a slower period of growth in the quarters ahead. The second is the role of fixed income. If you want income, you're getting that in the fixed income markets. If you want ballast, you are also getting that, or you're beginning to get that in the fixed income markets as the Fed slows down or even pauses after the next meeting. So I'll, sort of leave you with those two broad points.
And so with that then, as we look at fixed income, you like short-dated, high-quality fixed income. What are some examples?
Sure. So again, coming back to the theme that I mentioned earlier about quality. So short dated is where you're earning the most amount of income, the most amount of coupon. If you think about something like the 1 to 3 year part of the corporate credit market, where you're looking at IG rated bonds about, a little over 2 years of duration, and you're able to earn a yield of over 5%. That is incredible and more than what you were earning in high yield just about 18 months ago. At the same time, if you just look at, a few just 1 to 2 year treasuries, even that is earning you a very high rate of return, close to about 4.5%. So looking at things like IGSB or SHY, we think those are areas of the market which are, again, high quality and are giving you that income in your portfolio that investors are looking for. I'll also say that in addition to the things that I mentioned, if you are concerned about a slowdown, if you are concerned around what might happen with the volatility, given the news around debt ceiling, given the massive rally that we've seen in large cap tech year to date, I think longer dated duration, so looking at something like the ag, which again is yielding above 4%, is something that investors can be considering in their portfolios as a provider of ballast in their portfolios.
And you do note that even though it's a challenging time for equities, there can be some opportunities here, especially for those that have global exposure. Break down the strategy and how you're picking those.
Sure, Rochelle. So what we think about are twofold. Number one, where can companies have earnings growth, right? So looking at that growth measure is really important. But at the same time, it's not just about growth, it's also about valuation. So we call that sort of looking at growth at a reasonable price. So what are some sectors or industries in the area, in the markets that not just have the potential for stronger balance sheet, that have the potential for earnings growth, but are also reasonably priced? And this is where we think global energy companies, as well as global tech companies, also looking at something like semiconductors, those make a lot of sense in a portfolio. And then finally, looking at something like quality or QUAL, which is a ticker that we really like, which again gives you a sector neutral, diversified ways of approaching those companies that have better balance sheets, better margin, and better profitability.
I mean, it does seem like some investors are going to be perhaps caught off guard or have some cold water thrown on their expectations. I mean, you're saying that you're not expecting, you said that market expectations for the Fed to ease significantly before the end of the year are misplaced, especially when you look at that core PCE number. So what sort of timeline do you think realistically investors should be looking at?
Yeah, it's a good question. So I think when we, historically, when we look at the 1990s period all the way till now, the pause period, the period in which the Fed does their last hike and then, sort of pauses for a bit before they start cutting, has been about 10 months. That has been the average pause period. Now, around this cycle, could that be shorter? Certainly, especially if we continue to see a moderation in the job market, like we did with the JOLTS data this morning, like we have seen with the PCE as well as the CPI data, still very high, but moderating lower. I think in those environments, we can certainly see the Fed pause in May and then keep rates at this higher period for longer, maybe till the end of the year, before they determine in the first quarter of 2024 if they need to actually bring rates down. And what that will depend on actually will be, of course, the trajectory of how the job market plays out, where we're getting additional jobs from, whether it's just leisure and hospitality, as we've seen, or whether there's a broader availability of jobs. And number two, of course, the trajectory of inflation. What is core X shelter doing? Are we beginning to see a move downwards, or are we continuing to see some stickiness in inflation?
Well, you know, when you have a data-dependent Fed, every announcement matters. Thank you so much for joining me this morning, Gargi Chowdhury, BlackRock America's iShares Investment Strategy Head. Thank you so much. All right, time now for our trending ticker, and we're looking at shares of Chegg. The education company still sliding on its warning that ChatGPT could threaten growth of its homework offerings, with CEO Dan Rosenzweig saying the chatbot was, quote, having an impact on our new customer growth rate. The comment's notable for being one of the first corporate acknowledgements of the impact of ChatGPT and AI across various industries. See there the stock down more than 48% this morning. All right, coming up, macro risks, innovative digital products, and private equity moving into the space. The headwinds pile up for wealth management. We speak with a key player live from Milken next. Let's do a quick check of the markets sponsored by Flex Shares. We're still seeing that selling action continuing. All major indices now currently bouncing around the session lows. The Dow now off more than 540 points or 1.6%. The S&P 500 also down about 1.7% or 70 points. Tech-heavy Nasdaq also down about 182 points there, down 1.5% as we are in the thick of earnings season and also bracing for that big Fed announcement coming up tomorrow. Well, wealth managers have had their work cut out for them lately. Advisors of all stripes have been managing the risk of contagion from the biggest bank collapse in years. The main goal, protecting clients from the fallout. Now, it would be an understatement to say the status quo has shifted. The industry has been changing for years thanks to a proliferation of new investment vehicles and unprecedented technological change. Add to this another seismic shift, private equity moving into their space. The growth of private wealth made this move inevitable, but even so, the battle to win the high net worth investor is more vicious than ever. McKinsey has labeled the desired change as the Netflixing of advice, hyper-personal and yes, potentially subscription-based. Alternative asset manager Ares Wealth Management has established quite a presence on the scene across private equity, credit and real assets. Now, the business's retail arm, Ares Wealth Management Solutions, oversees product development, helping investors diversify with the help of private markets. So is this the right time to take that plunge? Well, let's get to Yahoo Finance's executive editor, Brian Sozzi, at the Milken Conference in Los Angeles. Hey, Brian.
Hey, Rochelle, good to see you here. Joining me now is Raj Danda, partner and global head of wealth management at Ares Management. Good to see you here. Raj, I think this has been an interesting week in finance. We've seen JPMorgan scoop up First Republic. We're on the eve of potentially another rate hike from the Fed. What's next for markets?
Well, Brian, great question. Good to be here. We really are on the heels of extreme volatility last year in the equity markets, recently in credit. As you mentioned, the credit contraction that's been engineered has led to some bank failures. Ares is really a micro investor that's aware of the macro, so our crystal ball is what it is, just a crystal ball. We do think the Fed will raise rates later this week, but what we spend time doing is providing advice to individual investors in our wealth management platform. We're one of the larger platforms and talk to 7,000 or 8,000 advisors every quarter. What we hear are really three things. One is investors want help with a more defensive portfolio today. They certainly want to benefit from the move in interest rates, and then inflation is on their minds. And so we're helping them think about portfolio construction with that in mind.
Why is the broader market, and you're not the first one that has told me investors are starting to get more defensive positioning or more interest in that. Why is the broader market holding up, you think?
So the public markets really don't offer much breadth to the economy. Less than 10% of companies over 100 million in revenues are in the public markets. Ares' lens in the private markets actually gives it great breadth. Middle markets has been core to our franchise. And so what we see is an opportunity to capture both alpha through private credit, through secondaries, through distressed strategies. And you're absolutely right. The public markets are distracting. There's volatility. Individual investors historically have had effectively 100% allocation to the public markets. The age-old 60-40 allocation I think of as 100-0, 100 to the public markets, nothing into the private markets. Now that's changed with maybe 4 or 5% allocated to the private markets, but that's where we spend our time thinking about those opportunities.
Is 60-40 dead? That seems to be another topic here at the conference.
Well, again, I think of it as what is the right portfolio construction that achieves clients' goals. So take, for example, private credit. We manage about $360 billion in assets, about 2/3 is in private credit. Some people would say we're a pioneer in credit. I think the advantages of private credit today are really apparent. One, most of the assets are floating rate, and we've had a material move in the base rate. Secondly, you're defensively positioned. As I mentioned, that's topical for clients. So you're senior in the capital structure. You have a cushion to if asset prices decline. So we see a lot of interest in private credit. We also see the need for diversification. As I mentioned, the public markets don't offer a lot of diversification. Secondary strategies, and another area that Ares has a 30-year track record, is where you can achieve diverse exposure in private equity. You don't have a J curve. You don't have to get the vintage perfect when you're investing in private credit. So those are two areas that we see a lot of interest.
you mentioned you don't have a crystal ball, but what is your macro outlook? If you see people getting more defensive, you see a potential spike in volatility, what does that say about the economic outlook?
So it's a good question. I mean, we reported earnings for ARCC. It's the largest BDC just last week. And we did see 8% EBITDA growth across the platform. So we don't see some material or severe contraction in the economy. If you think about the massive both fiscal and monetary stimulus over the last several years, there has to be now some impact from credit tightening and values coming down, asset prices coming down. But the underlying economy feels pretty good to us.
As someone who manages money and is exposed to this industry, how concerned are you about a default on the country's debt? Lots of focus on the debt ceiling.
Again, the headlines are creating volatility. You'd like to believe that there's some brinksmanship and some politics around it, and that it's a matter we'll get through. Again, the volatility in credit is more recent. In the last year or so, we had volatility in the equity markets. Credit markets, public credit markets aren't meant to have that type of volatility, and that certainly is causing distractions for investors.
Lots of chatter at the conference, too, about the outlook for commercial real estate, which your firm is familiar with. How concerned are you about the outlook for commercial real estate in this country as, again, we might get another rate hike, and we still might get a few more? The Fed has given no indication it's getting ready to step off the gas.
Commercial real estate's a large asset class. There are clearly signs of some distress for office assets in large cities. That's a very small part of what we do. Our focus has been in industrial or distribution warehouses and in multifamily and some of the Sunbelt communities around the country. So it's a large asset class, but we certainly are concerned about the headwinds. An area of opportunity in commercial real estate is within debt, and we find that today you can get equity-like returns from commercial real estate debt, and the firm has a credit DNA, a meaningful, large commercial real estate debt practice, and so we're trying to take advantage of those opportunities while being cautious and sanguine about the headwinds elsewhere in real estate.
I think Charlie Munger really scared the heck of a lot of people with his FT op-ed over the weekend on commercial real estate. Is it more of a rolling crisis? Is this something for next year we should all be concerned about? Or, it could happen at any point?
I think it'll be over time. You'll see the impact of this sharp move in the base rate and financing rates. Commercial real estate is an asset class that historically has leverage associated with it, and interest rates have moved materially. So there'll be a period of time where it'll unwind. But again, core strategies for real estate can withstand some of the move in interest rates if you see rent growth that we have seen in certain parts of the real estate market.
Is return to office still a major contributing factor in what you are seeing in the commercial real estate market?
So as I said, office is less than 10% of our exposures, both equity and debt, and it's not something that we see in our portfolio, but certainly, as you and I were discussing, return to office is topical, will remain topical, and something that's on everyone's minds, but not as much as an investment practice.
I'm back in the office, Raj, and I'm wearing a tie, and I'm okay with it.
Well, I think you look good with the tie.
You look good with that one, Raj.
Hard to know how your office is, but our office is back. It's busy, and we're happy to be there.
All right, well, good to see you, Raj Dhanda, partner and global head of wealth management at Aris Management. Enjoy the rest of the conference. Appreciate it.
Thanks for having me, Brian.
Guys, back to you.
All right, great stuff there. You heard from Raj Dhanda, Ares Wealth Management Solutions Global Head of Wealth Management, alongside Yahoo Finance's Executive Editor, Brian Sozzi. Great stuff there. All right, stay with us. Coming up, the ride-hailing economy. Uber reports another quarter of strong growth as customers keep drivers busy. Is this a leading indicator of a strong U.S. consumer? We discuss next. Uber's first quarter results demonstrated strength as its trips rose 24% across its offerings, which helped boost mobility revenue 40% in the quarter. But what does that suggest about the state of its riders and the broader consumer? Yahoo Finance's Dan Howley has the latest. So Dan, break it down for us.
That's right, Rochelle. Let's just go over the numbers real quick for Uber, which squeaked by analysts' expectations for Q1. We had revenue at $8.8 billion. That beat the expectation of $8.7 billion. An adjusted loss per share we had at 8 cents. That met expectations of 8 cents. But the broader picture is, as you alluded to, that the consumer strength. And so that leads us to the bookings. Bookings is basically how many, the amount that Uber earned through bookings on delivery and mobility. So gross bookings came in at $31.4 billion. That met expectations. We had mobility bookings. That's being driven around by an Uber. That came in at $14.9 billion. $14.8 billion was what was expected, and that's up 40% year over year. As far as overall gross bookings go, delivery we had $15 billion. That's a beat on $14.9 billion. That's up 8%. And then trips were up 24% this year. I think one of the things that's worth noting, though, is how much the market is reacting to this. We had in pre-market action, Uber was up 7% on the news. And you could see that this is something where, the consumer obviously not falling apart as much as was potentially feared, and the mobility picture really coming back. During the COVID years, the company was living and dying by its delivery service, which at that point they had referred to as the Eat service. And so that's continued to expand while mobility has really come back. So the company's really firing on basically two fronts and doing a really good job of it. I think one of the things that's also worth pointing out, though, is the potential, and I say potential, for increased competition from the likes of Lyft. Obviously, we had Lyft's new CEO on with Brian Sazi, and they were discussing how Lyft wants to become more competitive with Uber. That could mean price cuts on Lyft to make it more competitive with Uber. But as I said, Uber has the drive mobility part, the delivery part, and then the freight part. So they have a number of different avenues to bring in revenue, whereas Lyft is really limited as far as that goes. So I don't expect them to overtake Uber. I don't think anybody really does. But, maybe when the next time you decide to get into a cab, you'll look at Lyft and Uber again.
I'm one of these people who, once I sort of have something I like, that's kind of my go-to, and I don't even double check. And I think that a lot of people do have that, but we know that during COVID, people were doing a lot more price comparison. What about the international market? Because I know that was also a bright spot for Uber here.
Yeah, obviously they're trying to continue to expand the international market. They are large there. And so that's something that's going to continue to be a benefit for them. Again, comparing between that and Lyft, Lyft just doesn't have that, right? Uber is an international organization, whether they're operating as they do in the U.S., where riders are contracted to them, or they're working with taxi services. They also are adding or working to add all New York City taxis to Uber, so this way you can call a regular cab rather than having to hail it on the street. You can still get that classic New York experience if you want. Go out and stand on the street and raise your hand. But if you'd rather not do that and you'd rather call from your phone, you can do that as well. So, yeah, continued improvement for the international market there, though.
All right, thank you for that update. Yahoo Finance tech editor Dan Howley. Good to see you. All right, coming up, Vice Media reportedly edging towards bankruptcy. It's a staggering fall for what was once one of the highest valued private companies in the United States. We talk changing media next. A company once valued at $5.7 billion might be headed for bankruptcy. That's according to various reports. Vice Media reportedly approaching that cliff edge, while the change of finding a buyer remains on the table. Now, its potential downfall underscores the tough environment facing digital media companies as they struggle to cut spending during economic uncertainty. Here with more on the changing media landscape, we have the Washington Post media reporter, Elahe Izadi. Thank you so much for joining me this morning. So, I first want to start with Vice, obviously a spectacular fall from grace. How did it get to this point?
Yeah, so as was mentioned, Vice Media raised billions of dollars. At one point in 2017, it was valued at $5.7 billion. It came out in an era, it started out as a magazine based in Montreal with a sort of punk sensibility. It grew into this multimedia company that attracted billions in investment. At one point, Disney and Fox reportedly both explored buying the company. They invested hundreds of millions of dollars in there, and it grew into not just having its own TV network, it's having its own film studio, but also producing Emmy award-winning documentaries and series. It really ballooned into much more than just this magazine. And, it came out in this era in the 2010s. We could look at this time in digital media, one in which there were a lot of hot media companies that did raise lots of money. There was lots of interest, and they promised essentially that, look, we are the future. We are the future of media. We can attract millennials, younger audiences. Newspapers are dying, print is dying, and this is really the future. And they sold this promise. And as we can see, they couldn't grow fast enough to make up for those promises, especially when we're now in an economic environment where the advertising industry and the advertising revenue has dropped off. And also, these companies sort of banking on these other companies like Google and Facebook, and, an algorithm can change and that can totally disrupt your business model.
I mean, when you think of just how much media has changed, even over the COVID years, the things that we didn't think were possible. I mean, you also have changing viewer behaviors with more streaming. You mentioned reduced ad spend here, higher costs with inflation. Do you think, was there a particular inflection point when it comes to digital media, or was this sort of the bearish signals were already flashing?
I think they were already flashing, but the pandemic certainly accelerated a lot of trends in media that were already there. I mean, the same thing happened with print and newspapers. But when we're talking digital media, it was very fascinating to me because actually during the pandemic, and especially at the start, we actually saw audience spike. There was a lot of online interest, reader interest. We saw a lot of that happening, but that didn't necessarily mean an increase in revenues. And then over time, audience dropped off. And so that was a dynamic that played out. And in addition to the bigger economic issues at play, we saw rounds and rounds of buyouts and layoffs. Vice Media has gone through many layoffs in addition to just recently closing and shuttering its news program, Viceland. And so, even though Vice and other media organizations may have been producing award-winning journalism, hard-hitting journalism, Vice was known for sort of going into conflict zones, covering human rights abuses, also kind of taking on a gonzo approach, journalism approach. Even if your product is really good, that doesn't necessarily mean that the business model is there. And just stepping back, since 2005, that's the peak of print revenue, of ad revenue. And ever since then, media across the board, journalism industry has been struggling to figure out a viable business model. Is it dependent on ad revenue? Is it dependent on subscribers? Is it a mix? Do you have sponsorships? And that's really what we're seeing playing out over the last few decades, but particularly the last couple of years.
And I mean, even from the start of the year, when you look at the different companies that have had layoffs, I mean, it's not just your Vice, you've got your BuzzFeed, ESPN, News Corp, Disney. It really is a laundry list, including, GANnet as well. So then where do you think these signals are heading in terms of what's next for the state of media? Is it more consolidation, or are we going to see some of these companies just dying out?
I think, we've already seen BuzzFeed News. I'm thinking about their food listicles on BuzzFeed News closing down. You've also seen, I watch especially and pay attention to local and regional media. Like every month we see newspapers close down, whole newsrooms shut down. I do think we're going to see a shrinking of the job force. But also the bright side, I guess you could say, is in a moment of volatility, there's always experimentation. There's always an appetite to see what could be the next big thing. And we are seeing some digital media companies starting in this moment. The Messenger is one. We see smaller ones like Semaphore still trying to make a go of it in this moment, still trying to figure out a way to make good information and good journalism viable from a business perspective. I still think there are investors who are interested in trying to get in on the ground floor. So I still think we're going to see more media companies come into the fray, even if we see these now, they might be considered legacy. It's interesting to think of BuzzFeed as a legacy company shrinking.
And I mean, this is coming at a time you have this convergence of, a tough macroeconomic environment. You have some high profile names at Fox and CNN being laid off within their own sort of issues within their own companies as well. And then now you have AI coming into the fray as well. So when you sort of put all that together, what does that mean for what investors could expect for what the next phase of media will look like when you do have things like AI and some of these big names off the table?
Yeah, I do think AI is that big thing that everyone is paying very close attention to. They're very interested, I could say, in the audio and podcast space. That is a big topic of conversation right now. How can AI sort of perhaps reduce overhead or take on some of the work that people take on? I will still say that is a very uncertain space. You're still going to need human involvement, but I will say that that is a space that a lot of people are paying very close attention to. And again, I think in this moment, if you're an investor or someone who, or a company or a private equity group who is interested in experimenting, in taking a risk, this is a moment where there's a lot of risks to potentially take on because it's a moment of big experimentation. No one has figured this out yet.
Well, it certainly does mean that there are opportunities there for some first movers here. Elahe Izadi, thank you so much. Media reporter for The Washington Post. All right, earnings now. Pfizer out with a beat on the top and bottom line in its latest quarter. However, not without reporting a sharp drop in first quarter revenue on the back of falling sales of its COVID-19 vaccine. For more color on Pfizer's commentary from its latest earnings call, let's get to Yahoo Finance's Anjali Kemlani. Hey, Anjali.
Thanks, Rochelle. Yeah, to your point, Pfizer doing pretty well when it comes to just the numbers, but not necessarily getting that boost in sentiment from the street. And that's something the company honestly has struggled with since pre-COVID. You heard the CEO, Albert Bourla, address this at the very end of the call, talking about the stock itself feeling undervalued. He said specifically, quote, the stock price does not reflect the value that Pfizer has. So looking at it from the perspective of this company that, to your point, the COVID vaccine, the COVID treatment, really having a strong portfolio, and then looking out to this year where it's expecting to launch a dozen products in the second half of the year alone, it really does, beg the question, what is Wall Street looking for and when does the company get that boost? And so, to that point, my vibe for this call is definitely leaning towards good. You saw some of the questions from the analysts, focused on that, on the long-term outlook, on the product, especially on that acquisition of that $43 billion acquisition of Seagen. But you did get some harder questions on, the general lack of anything but the vaccines and COVID right now, looking all on that. So that's, I think, would quickly summarize sort of what we heard on this call today and where Pfizer stands. Still a strong company, cash on hand, still strong, but I think overall still some questions about what its long-term outlook looks like.
Well, Anjali, to that point, post-COVID, a lot of people are wondering what's going to be that next catalyst, if there is one, that Pfizer's going to be honing in on. Did we get a better sense of that on the call? Yeah, there are a couple different segments. So, of course, with Seagen, the oncology, that's supposed to bring in about $10 billion by 2030. They are looking at, a couple of patent cliffs on some of their older blockbusters. So to fill in that, they definitely have the RSV vaccine and multiple options there. Very strong, bullish
sentiment from the company about the combination COVID RSV and COVID flu, those options in the long term as potential, big revenue hubs, as well as Prevnar. That's the pneumococcal vaccine. That is about a $6 billion product for the company. They have a new formula out, broader coverage. So there's that. They're also in the background just talking about we didn't hear anything about this on the call, but they are also looking to enter that obesity space with an oral GLP-1. So no updates yet. It's still sort of mid-stage in its trials right now. So going to be interesting to see how that pans out for the rest of the year.
And we know that's been a hot button issue for a lot of big pharma companies trying to get into that space. Thank you for that update, Anjali Kemlani, there for us. All right, coming up, bargain hunting. The Oracle of Omaha is known for getting a deal in Japan, and he's not alone. Private equity and hedge funds also looking to the nation. We discuss and look to Berkshire next. Warren Buffett's latest bet is paying off. The billionaire investor seeing big gains from his stakes in 5 Japanese trading companies. We're diving deeper into Buffett's overseas venture ahead of Berkshire's annual shareholder meeting coming up this weekend. Joining me now is Samantha Leduc, Leduc Trading founder. Good to have you back on the show, Samantha. So a lot of people wondering about this play here. Good to have you. So these trading firms that Berkshire Hathaway investing in, the 5 largest trading houses in Japan, really represent companies that are integral to the economy. Talk about this move and why do you think he's making this move at this point?
Well, first, Japan in general is very important. They are the largest buyers of U.S. treasuries. They also are a very large importer of nat gas. And since they have done their yen interventions back in September 22nd, when the gilt market, by the way, imploded, and also throughout mid-October into December, widening their yield curve control, they have very much put a bottom in equities. And this is basically this yen intervention en masse with central bank coordinated liquidity infusion. So it's a key player with the United States in supporting our equity and bond markets, first and foremost. Second of all, it has some very interesting characteristics. It is the last bastion of low yields in this global world of hiking regimes. So in the backdrop of Japan having the lowest yields in the world right now, is one of the benefits, if you will, of going over where Buffett has already proven this, went in before they widened their yield curve. And again, I think they will do it again. Berkshire went in 2020, August of 2020, took a 5% stake in these holdings, mega conglomerates in Japan, where these are basically trading houses. They're very much instrumental to everything that goes on in Japan, from their distribution of consumer to industrials. Again, a lot of commodity-based value shopping right there. And it's clear that Buffett is, ahead of the game, because he not only sold Berkshire bonds in yen, which yielded very nicely for him, but he bought interest in these commodities, in these trading companies, which has then been increased to about 7.5% holding. And that's not usual for Buffett. I mean, he's usually kind of a bottom-up fundamental approach to investing. So why does this matter? Right. First, I think it's very important that it shows this investment in things over paper. And that's been a mantra of mine since summer of 2020. It also indicates that Japanese yields are likely to start to rise. So Buffett is bullish Japan. Very likely investors will follow.
And to that point, I mean, these are also these five trading houses. They all have price to earnings ratios of below 10. They pay healthy dividends. But some of them also represent a pivot away from fossil fuels. So when you look at the energy play that Berkshire already has, what should we make of this?
Well, I'm not quite sure that this is a longer term bet on the demise of fossil fuels. Absolutely not. I just think this is a very strong bet on commodities. So, Druckenmiller has his dollar short thesis. Marginally, the dollar is, devaluing relative to rest of world currencies as it relates to commodities. That's very bullish. So I really think this is more a play on these yields are going higher in Japan. This is obviously supportive for not only the trading houses, but stocks and countries that are asset rich, resource rich. I think this is a very smart play on higher commodities, not necessarily fossil fuels, but their dependence on importing energy is obviously famous. So this is a really great gateway play for Berkshire to take advantage of these value plays.
And so when you compare that to the investment landscape in the US, I mean, obviously we have a looming debt ceiling fight. We have still some uncertainty as to what the Fed will do next. Do we expect then the next bull run to be in Japan?
Well, I think this is putting in a play for there's value in Japan. Yields are likely to rise in Japan. There are still many problems in Japan, demographics and debt to GDP. But as it relates to these subsidiaries basically benefiting from an inflationary impulse, it's very smart to basically, issue these bonds in yen to buy commodity-rich trading houses. So it's Buffett locking in world's cheapest source of funding to then buy access to hard assets. As it relates to the U.S., we will have a different complexity because we're actually at the end of a Fed hiking regime, right? We're expected on Wednesday for the Fed to be one and done, one last 25 basis point hike. The market is very jittery about that, by the way. Today, as you can see from VIX spiking off that 16.5 handle that we discussed last time I was here. And the dollar yen has moved higher. Definitely USD JPY, again, that was my baseline bet from 134, 135, 137. We're digesting here a little bit. Above this, we're going to push into 140. So this has impact on our dollar, on yields, equities, and they're feeling that nervousness No question. And the ultimate play, I believe, is dollars coming under some pressure, probably into the 98 handle for Dixie this year. And right now, it doesn't look that way. It looks like we're getting a little support into 103. But after this unwind, after this yen unwind that I talked about on the last show, there is a massive crowded yen long carry trade that we have seen unwind in the past few weeks. And I think it has further to go. So it definitely, the carry trade matters to U.S. equities. And we're feeling some of that volatility come into play right now ahead of a potentially hawkish Fed with one more rate hike and pause in June.
And we know people will be passing through those comments on Wednesday from Powell. A big thank you there. Samantha Leduc, Leduc Trading Founder, thank you for your time this morning.
Thank you so much.
Well, you're so welcome. We're bringing you more Berkshire coverage ahead of Saturday's big show in Omaha. Tomorrow, a closer look at Buffett's bet on Occidental. You won't want to miss it. Stay with us. We'll be right back. Time for today's trending tickers. We're looking at shares of BlackBerry, BP, and Sprouts Farmers Markets. Starting off with BlackBerry, those shares on the rise after the company announced it will undertake a strategic review and possibly break up its cybersecurity and QNX units. It hasn't yet set a timeline for the review and doesn't plan to disclose any developments on this as of now. The stock, though, up almost 8%. And oil giant BP stock falling after the stock posted profit that beat expectations but decelerated from a year ago. The company also slowed the pace of its stock buyback program, announcing $1.75 billion in buybacks versus $2.2 billion last year. That's taking a more than 8% hit on the day. And next, Sprouts Farmers market shares are moving higher after the grocery retailer beat on its first quarter earnings and its same-store sales rose over 3% during the quarter. Its e-commerce sales grew double digits and represented over 10% of total sales. That was boosted by the company's recently improved digital experience, the stock being rewarded there, up more than 7.8%. Well, that does it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. See you then.